So the II is marginal costing for 6 months. So let's see how it goes by. In marginal costing, remember the first thing we are interested in is contribution. So your contribution is selling price or sales minus variable cost. And remember, like we said in the previous discussion, variable cost includes both what? Production and then non-production variable cost. So once you have your contribution, you get your net profit. Get your net profit. So how do you get your net profit? Your net profit will be contribution minus fixed cost. Contribution minus fixed cost. So that is the idea under marginal costing. Contribution, that's the first thing we are looking for. Net profit is contribution minus fixed cost.
And contribution, variable cost is production or?
Variable cost includes both production variable cost and non-production variable cost. So let's see what we got here. Now, less marginal cost. What I wrote here as marginal cost could also be variable cost. It's the same thing. Marginal cost is the same as variable cost. So sales, it will be the same thing. There is no opening stock. So let's just put that there. Material cost, direct. It's already here, so we just pick it up. 100,000. That's a good thing about this.
So when you're writing as answer, you can just pick that. You don't need to put the 5 times.
No. It's already here, so you just pick it and bring it. Then that gives us a prime cost of 200,000. Then we add factory overheads, and this is where I want you to be careful, because here, unlike in absorption costing, where we brought both fixed and variable, in marginal costing we will be bringing only the variable. So add factory overheads, and that's variable, and it's already here, 40,000. And so that is what gives us the cost of production. That's the difference I want you to get, and that's 240. So once you have your cost of production, or marginal cost of production, we're going to be bringing less closing stock. And we will do workings for that, like we did previously. We already have all these. So closing stock, the same idea. Unsold units, 3,000. Units produced, 20,000. This time around, the cost of production is what? That's what you got to understand. So realize that the valuation of the closing stock is different in both cases.
Because of the fixed cost.
Yeah, because of the non-inclusion of the fixed cost.
And why
Yes, because of the idea I mentioned about here, that in marginal costing we are interested in contribution first, and contribution is sales minus what? Variable cost. So you only bring and because all the fixed costs will have to be written off later on when we are getting the net profit. So as far as you want to get your contribution, you don't bring the fixed cost. So what do we have? 3/20 by 240. $36,000. So less that. That gives us the marginal cost.
is it correct?
Yes.
204.
204. Subtract that from the sales, and that gives us factory margin. Factory margin. 306. Be careful how we are building the thing up here. We get our material cost labor cost to get prime cost. Factory overheads, we only bring the variable. The fixed will not come. We less our closing stock, and that gives us the marginal cost. When you subtract the marginal cost from the sales, you get factory margin. Why is that so? Because there is a non-production overhead. There is variable non-production overheads, and that is what? The selling expenses. So you bring the less the variable non-production overheads, and that is the selling expenses. How much did we get there? 51,000 is going to be the same thing. So subtract it for me, and now we can get our contribution. $255,000. So that's our contribution. So assuming there was no variable selling and selling expenses, this would have been the same as what? The contribution. That's it. But because there is a variable non-production overheads, and looking at factory margin, because everything we've dealt with here is about production. So when we take it from the sales, it's about the margin we are making from the factory. Now from here we can less all fixed costs. So let me clean this up about here and continue from here. So we less fixed costs. And what are our fixed costs here? We have factory fixed costs. So let's bring them one after the other. The factory is 160,000. And then selling and admin, that's 80,000. And that adds up to 240,000. So you subtract that from the contribution, and that gives you net profits. 15,000. What did we get for this one? 39,000. Okay. So that is the idea about.
Why this one is bigger than that?
Yeah, because of the valuation of the closing stock.
So let me ask.
Yes, ask.
Selling expense is variable cost, and the selling administrative cost. How?
It's in the question.
I've tested.
I'll say the total. Okay, let's go back there. Also, GWAP incurred a variable manufacturing overheads cost per bottle of 2 Ghana cedis and variable selling expenses of 3 Ghana cedis per bottle. So that's variable selling expenses. Then it says total annual fixed costs incurred during operations were 160,000 on manufacturing overheads and 80,000 on selling and administrative expenses. Do you get it? So that's how we know and how we classify statements there. So that is it about that. So that's the difference between the absorption costing and marginal costing. So you have 36 here. Absorption costing and marginal costing. So realize that the closing stock here is 60,000 and the closing stock here is 36,000. If you strike it out, what's the difference? 24,000, right? When you strike out the difference in the closing stock, when you add it back to this, it gives you the 39, right? So sometimes the examiner will ask you to prepare a reconciliation statement where you reconcile the marginal costing profit with the absorption costing profit. In other words, why is the difference? It is all based on the valuation of the closing stock. So all you do is you bring your marginal costing profit, 15,000, excess valuation of closing stock, 24,000, and that gives you 39,000, and that was the absorption costing profit. So there you go for 13 marks for these questions.